Hi, today is December 3rd, 2022. I'm Jason Shapiro with crowdedmarketreport.com. Bunch of things I was going to talk about today, but I think what I'd like to focus on is a conversation that I had this week with a guy. This guy was telling me his story and how he trades, and he was the CIO of a big CTA for a number of years. It ended up blowing out, and he really was just giving me all of his history and then all of the excuses of why none of it worked. He told me about what he does. He says, I'm a systematic macro portfolio manager, which in theory is supposed to mean macro, looking at the whole macro environment and then using a system to trade that. But what that means to me is he's a trend follower, because that's what all sort of macro people end up being anyway. And if you're systematic, then that's certainly what you're going to be. And I said that. I said, so you're a trend follower? And he said, yes, we take signals off of trends, but we size the position based on if the macro agrees with the trend, then we size it bigger. And if the macro doesn't agree with the trend, then we size it smaller. And my comment was, I would do the exact opposite of that. Why would you want to get into a trend where the macro agrees with it, which means that everybody can see that, right? Which means that everybody's going to be on this trend, which means that when it turns, it's going to be nasty against you, right? Because the market price turns before the macro turns. We know that. The market doesn't just go up because the fundamentals are good, and then the fundamentals go bad, they ring the bell and you sell, and then it goes down. Not how it works. Market obviously moves, being a discounting mechanism, moves way before that. And if you have so many people in it, because A, the trend is going your way, and B, the fundamental macro is going your way, that when it turns, it's going to be super ugly. Okay? I would do the opposite. I would size bigger in a trend that is not being, at this point, confirmed by the macro story, and I'd shrink things that were being confirmed because it would be getting too crowded. And that will give you, I promise you, much better return to risk. You might miss some kind of huge blow up macro event where things all do something and you're on it, but you're also going to miss the reversal of that, which is going to kill you. So your return to risk over time is going to be much better doing it the other way. So I thought that was an interesting conversation and something to point out, because it gets right into doing it, how to do it the wrong way. And just as an aside, right now, what's going on in the stock market, I think, is the perfect example of that. The trend, clearly, if you take the Dow, the trend is clearly at this point up. Does the macro agree with that? It might in time, but certainly right now, everybody's opinion is that it does not. I don't hear a single person that thinks that the stock market should be going up. They all are of the definite belief that there is recession next year. Whether it's a mild recession, whether it's a deep recession, maybe it's up for debate, but that there's going to be a recession is not even in debate. And I guess a recession is theoretically bad for the stock market, which I personally would argue with as well. It depends. It might be. If everybody's long, it's going to be bad. If no one's long, it's not going to be bad. But the macro certainly doesn't agree with the trend at this point. So you wouldn't be riding this trend very well if you were picking to go with a market where the macro, did agree with the trend. One way I always like to say it is, if let's say you have two markets and they're doing the chart looks exactly the same. They're both trending up in the same way. Would you rather be in the one that everybody is in, or would you rather be in the one that nobody's in? And I will tell you, from a risk-reward basis, you would rather be in the one that nobody's in, right? You'll find out later why the market was doing what it was doing, but the risk reward is definitely in the one where there's less participation. So just a thought of how to approach that type of stuff based on an example that came up this week. I hope you enjoy that. If you do, please subscribe to our YouTube channel. And if you want more goodies and market thoughts and positioning stuff and charts and all kinds of stuff, please join us on crowdedmarketreport.com. Okay, and I wish you all a good week.